Hi everyone and welcome back to Ask InCred. In today's episode, we are diving into the world of digital and co-lending space. We will explore how digital partnerships are redefining credit ecosystem, making access more seamless, inclusive and innovative. And to walk us through this fantastic topic, we have with us Sunny Vazirani, Head of Digital Lending and Partnership at InCred Finance. With nearly 20 years of experience across Axis Bank, Kotak Mahindra Bank, and NPCI, Sunny brings a wealth of knowledge and perspective to this conversation. Hi, Sunny. Welcome to Asking Cred.
Hey Vaishali, thank you so much for having me.
Okay, let me start simple. What exactly is digital lending, and how is it changing the way people in India access credit today?
Okay, so digital lending is a vast topic. Let me try demystifying it for you. I'll start in layman's terms, right? So digital credit is nothing but the use of technology to enable and deliver credit to the end customer by simplifying the complete process from application to assessment and from disbursements to repayments. This is it in the layman's word. Let me double click a little bit on this for you. Digital lending uses lending service providers, LSPs, as we call it now in our language. These LSPs enable the end customers to come into the ecosystem. We leverage technology like AI, ML, and the most important, the digital KYC stack that's now being built. Most of the decisions now are also real time, unlike the last time where you'd wait for a couple of days for you to know you're going to get a loan or no. This has happened because of these scorecards, the models that are deployed to enable real time underwriting. So you know you're getting a loan, you're not getting a loan. If you are getting the loan or it has to be disbursed, this also happens in real time in today's worlds, unlike the earlier times. So in short, I think digital lending has made for an individual the process much faster, inclusive, and above all 24/7. And this is both for the direct digital or co-lending models. It's real-time disbursements that now we can roll out to the customers.
So, Sunny, you just mentioned about co-lending, right? What exactly co-lending is?
Yeah. So co-lending is nothing but two regulated entities, REs like we call it, be it banks, be it NBFCs, rolling out a singular unified loan to a borrower, but each one of them booking their share on their own balance sheets. This is the co-lending process. Now, in this process, there's a pre-agreed arrangement between the two regulated entities in terms of the fund flow, or for a matter of fact, assessment of the customer and servicing of the customer. That's co-lending for you in short.
So, Sunny, how is co-lending different from traditional lending model for both financial institutions as well as from the customer's side?
Sure. So in a traditional model that was followed, right, a single regulated entity owned the complete process from origination to underwriting, assessing the customer, disbursing the money to the consumer, repayments, collections, everything lied with a single regulated entity. Now, in a co-lending scenario, that's changed a little bit. Here, there are two separate regulated entities. One of the regulated entity could be great at last mile connectivity, could be a captive NBFC, servicing a special segment and a need, and is great at that, right? And then there could be another NBFC who's great on liquidity or cost of funds. The amalgamation of both of this creates a very strong arrangement out there, which we call co-lending. Now, and that's why co-lending is critical, because You've now got one NBFC that's great at last mile, one NBFC that's great at cost of funding, both coming in and giving a singular loan to the customer. Now, from a customer angle, when you think of it, right, nothing's really changed, on the surface of it. He yet gets a single loan, so it's not two different disbursals. He yet does one single KYC, and the disbursement happens in a single tranche. He also makes one single payment out when he's making a payment. But what this has done in the background for the customer is that for him, the reach of a larger NBFC is something that now he kind of gets. Second, because this is a blended rate of interest, he gets the benefit of a better cost of fund for him as well. So I think this is the most critical part of what co-lending has done for our ecosystem.
So, Sunny, very interesting question coming your way. The RBI's new digital lending guidelines have stirred quite a bit conversation. What, in your view, are the most important changes they have introduced?
Okay. So I think the guidelines were necessary, required, and I think they're steering the industry in the right direction. If I have to pick the top three most important things that the guidelines have given us, obviously the guidelines are very comprehensive, right? But I'm going to pick the top three that I think add a lot of value to the chain of digital lending today, right? I think to start with, the most critical outcome of these guidelines has been borrower protection. Now, in the erstwhile world, right, there were various things that the customer had to go through, be it opaque fees, data privacy issues, and host of other things that the end borrower actually had to go through. I think by the introduction of KFS, or the key fact statement as we call it now, RBI has made it very transparent for a consumer, from the loan amount to the processing fee, if there are any charges that needs to be mentioned in your KFS. In fact, the guidelines go on to say that if a charge is not mentioned in the KFS, you cannot be charging the customer that particular charge. So that's how transparent RBI has tried making it with the introduction of KFS. Another critical thing that's come out of these guidelines is the fund flow. Until now, you could send funds to a pool account from where it went out to a customer. There was no direct fund flow transfer from the regulated entity to the consumer. And charges could be deducted by the LSPs, or the lending service providers as we named them before, and host of other things that could happen on the pool account. RBI has now curbed that. Money flows directly to the end user, right? Which I think is a great way to get transparency back in the ecosystem. Another very critical thing on borrower protection that RBI has done is introduction of cooling off period, right? Now, what cooling off period does for you in layman terms is the return that you do on most of your online shopping, right? If in case there's something that is not working the way you liked it. Right. Same thing with lending today, right? If there were certain promises made, or if the end product does not suit your need, each regulated entity will have its own period of cooling off, and you could call up and get that loan cancelled without any charges. So I think from that lens, RBI has made borrower protection of the utmost importance in these guidelines, which I think is great for transparency. It increases the number of consumers that you can actually get in on board, because they now trust the system even more. Other than this, I think the second most important pillar that RBI got is additional responsibilities on regulated entities like ourselves. Now, what happens is regulated entities use a lot of these LSPs, like I said, the lending service providers. Now, until now, or even going forward, these LSPs do not fall under RBI regulations directly, right?
Okay.
They're giving you some service or the other to help you with lending. They don't fall under the purview of RBI, because of which there was a lot of information getting misused, which now cannot happen, because what RBI has now enforced is that these LSPs need to be regulated, semi-regulated by the regulated entity themselves.
Okay.
So the due diligence, the technical due diligence, your material outsourcing guidelines, all of them start abiding on these LSPs as well. So the regulated entity now needs to, before onboarding, someone needs to be 100% sure of the quality of the LSP that they're onboarding, right? Which is again very critical from a consumer lens as well, right? And the third most important thing that RBI has tried to do in this is actually balance the innovation and regulation to an extent, right? And what I mean by this is, erstwhile before the DLG or the Digital Lending Guidelines came into play, there was a lot of data that you could actually source from the customer, right? And there were LSPs who could access contact details of the customer, the phone book is the contact details, or say the photo gallery of the customer as well, which led to a lot of furor in the past, right? What now RBI says is there are certain things that you cannot access. Contact book, photo gallery cannot be accessed. There are certain things for KYC, like a camera, that needs limited one-time access, right? So another very critical thing on the co-lending side and the other side was the introduction of the 5% FLDG, right? So I think what they've tried to do is make it a level playing field across the industry and tried seeing that the customer is protected at any cost. So I think that's what the guidelines have done. And just to reiterate, I yet feel it's in the right direction and for the right reasons that the guidelines have actually been implemented.
Great. So as you mentioned that now the photo galleries and the phone book restrictions are there, right? Are they able to access our emails?
So again, emails, there will be certain players where you can give access to emails, but you have to give an explicit access to emails, right?
Okay.
So it has to be explicit. The LSP needs to let you know that he is taking access and get complete.
So the concern has to be taken from the
an explicit consent. So it cannot be implicit somewhere within the TNCs. It has to be an explicit consent where they're telling you they're taking your email access and also letting you know why they need your email access.
Interesting.
So it has to be an explicit consent that the customer actually doles out.
So Sunny, how do these guidelines impact lenders, particularly in terms of transparency, compliance, and customer trust?
Sure. So we've touched upon transparency to a small extent in the earlier question, but let me answer that once again for you, right? In transparency, I think outputs like the KFS that we spoke about, the key fact statement, where you need to be crystal clear to the customer in terms of charges or the new fad around APR, which is telling the customer if there are anything included while disbursing, what will be your APR as an outcome of that, or if there are any charges that you will finally get the customer to pay. If that's not a part of the KFS, you cannot be charging the consumer, right? So I think the KFS has been one of the most important things if we speak about transparency for the consumer. Another thing which was critical that we spoke about or touched about before was the fund flow, which is now extremely transparent from the regulated entity to the consumer. No middlemen or no pool accounts involved in any of these scenarios. To move on to compliance, again, a point that we've spoken about briefly in the earlier question was the increased accountability on regulated entities like ourselves to ensure that the LSP is abiding by most of the regulations that have been set out, right? Now, this could be extra due diligence that we need to do on the LSP or the InfoSec insecurity that you might want to do on their app or any of the technology that they are utilizing as well, right? Another thing which is critical from a compliance perspective is data security and consent management, right? This is critical. As we discussed, consent management is critical from a consumer angle. He could give you consent to check his location or for a camera, and he has the right to revoke a lot of this consent once the process is kind of done or completed, right? And from a security perspective, or the data security perspective, there is, again, as I told you, there's a mandatory ban on his phone book or photo gallery for all the right reasons, right? I think it's extremely critical that you get access to what you actually require. Another thing from a compliance perspective that's now become critical is your grievance redressal. And this is at both ends, an LSP end as well as an RE end. So you need to appoint a GRO or a grievance redressal officer, where any escalation can actually be highlighted, and there's a certain timeline before which you need to mandatorily solve any customer grievance or give him his resolution around the loan. I think the third thing that you asked me was trust, right? And I think for a borrower to trust a lender is the most critical thing, right? That increases the overall pie of these borrowers to actually come in and borrow from NBFCs or any of the lenders that are available today for them. I think what these guidelines had done was help in reducing malpractices, right? Which was critical, right? We've spoken malpractices like we know what access to photos does for a lot of lenders, right? Used in collections or the phone book that's used to call up relatives or friends and families to name shame the consumers actually have now stopped because of these guidelines actually coming in, playing a very important role in how we kind of do it. It also helps build the credibility that's required for the industry to actually thrive, sustain, and grow, right? Which has again become a very critical part of these guidelines. Also, I think what they did in terms of trust was empowering customers, right? They did give them the choice that you do not like it or it's not as per what was sold to you. You have a cooling off period to go ahead, cancel it,
Right.
or for a matter of fact, letting you know very clearly and crisply in terms of what is available to you and what is not available to you. So I think that's what the guidelines did to the industry. And I think all the three pillars are extremely critical and core to the guidelines that we got delivered to us.
Great. So, what are the challenges you foresee?
So challenges, obviously, the guidelines have been around for some time now. So we've actually tied over most of the challenges that we did have. When they were introduced, right? There was this little bit of anxiety amongst lenders in terms of getting them rolled out. But I think over a period of time, people have come to realize they're critical, they're taking the industry in the right manner. And I think at this point of time, most of the lenders have actually rolled them out. All of the information, including data security, GRO, websites being updated, have actually happened in the past few years. So, yeah.
Great. With the fintech ecosystem moving so quickly, so rapidly, right? How do you ensure product like co-lending is relevant, competitive, and customer focused?
Sure. I think I'll broaden the horizon, right? Co-lending, digital lending. I think the industry is extremely nimble and reacting real time across all of the regulatory changes or any other changes that are being thrown at us as an industry. I think to be extremely nimble again, in my view, there are some very critical things that we do as an organization. I think having a very modular design comes core to us, right?
Right.
And these modular designs are across, the APIs that we've got, because they can adapt or the changes, if in case there are any required, can be done extremely quickly because of the modular design of the APIs that we've got, right? Or for a matter of fact, the scorecards that you've got out, right? They can quickly be turned around if in case there's a change that you want to kind of make in them, right? I think another very critical thing in all of this is and core to our business actually is your risk in policy and the scorecards, right? They need to be extremely competitive in a market like ours, right? Because you need to have your USP, your advantage out there, and I think this is what all of these policies, models in terms of risk-based pricing kind of do for us or deliver to us, right? Another thing which is very critical to keep the lights on at our end, right, is customer experience, right? Which again is very critical. And customer experience is not just customer grievance, right? Having a frictionless journey in, say, KYC for a matter of fact, right, is great customer experience out there, right? Or for a matter of fact, having the real-time dispersals when the customer actually needs it. Along with this, grievance also plays a very important role for us.
Right.
Keeping up with any kind of issue that the customer faces and helping them in real-time resolutions comes very core to us, right? So I think these three are very important pillars for us to keep and be relevant in an industry which is as fast-changing, growing like ours. Yeah.
Thank you so much, Sunny, for taking our time and sharing your insightful thoughts here and having this great conversation. Thank you once
Vaishali.
again.
Thank you, Vaishali. It was a pleasure.
And to our listeners, thank you for tuning in. If you enjoyed this episode, don't forget to stay with us for more conversations on money, credit, and future of finance. And please don't forget to subscribe to Ask InCred.